You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where investing is made simple. As always, we have an amazing show on deck with a fabulous guest. We have Gregory Zuckerman, and I'll take a minute to introduce you. But first, Gregory, thank you for coming on the program.
Oh, it's a pleasure.
You've got so many, it's tough because your book, we're going to be discussing your new book. You've written more than one, but the most recent is The Man Who Solved the Market, how Jim Simmons launched the Quant Revolution. So this is about billionaire hedge fund investor Jim Simmons from Medallion. But we also should mention your other books, The Frackers, the outrageous inside story of the new billionaire wildcatters in 2014, then an interesting departure from finance, but an important thing, Rising Above Inspiring Women in Sports 2018. So you've written a lot of articles. I remember reading a little bit about the Bond King. I don't know if you're the one that got him in trouble or not.
Yeah, I don't know if I'm in trouble, but we reported, I broke the story about how Bill Gross, who they called him the Bond King at the time, was fighting behind the scenes with his number two, Muhammad Al-Aryan, and eventually Gross left.
So, and numerous awards, obviously, writes for the Wall Street Journal, appearances on CNBC, and everything else. Let's start with this idea here. So, first of all, what was it like to sit down and have access to Jim Simmons? What's he like?
So he's a remarkable individual, for those that don't know anything about him. Jim is a quant. He deals with math and science. He's among the most important mathematicians and certainly geometer of the last 50, 100 years. He was doing predictive algorithms while, Mark Zuckerberg was still in grade school, and then Netflix wasn't created, and Amazon and Facebook and all that kind of stuff. So he was doing big data, doing algos, in some ways, a trendsetter. Jim Simons is the reason why everyone's trying to catch up, and the guy's annual returns of 66% a year. So spending time with him is a privilege, because he's a fascinating individual. Even if he had never invested, I'd say he's still worthy of a book.
For those that don't know, we have fundamental analysis, which is maybe the Warren Buffett style. Let's find a valuable company like Coca-Cola and hold them for 50 years. We've got the technical guys that read charts and, see the tea leaves and the charts up and down. We've got guys that really manage risk well, more almost like a casino game where we say, hey, we're going to really make sure we do position sizing well and we hedge really well. So, talk about what the quant revolution is. If you're a quantitative trader, what does that mean if a person's a quantitative trader?
Sure. It basically means you turn the decisions over to the computers. You believe that those of us who use intuition and judgment and sort of old-fashioned analysis, looking at financial reports, talking to corporate executives, that leads to mistakes. And the idea is by tracking the market, the idea of Jim Simons and his colleagues at Renaissance Technologies is that past patterns in some ways suggest what's going to happen in the future. They predict the future. And you can see them as really much more sophisticated version of technical analysts. And they focus on trends in the market that maybe the human eye miss, and they pick up on them. And that's how they've been able to beat the market. So quants are who dominate on Wall Street, and they're basically the idea of using computer models and pre-programmed programs to beat the market, as opposed to old school trading styles and approaches.
So, most people didn't go to MIT and teach mathematics. Most people didn't spend time at Harvard teaching mathematics to figure this stuff up. So most people are not going to be doing this. But I think there's a lesson for everyone that wants to try this. And I don't know if you can eliminate it completely, but in chapter 6 of your book, it talks a little bit about this emotion stuff. And actually the caption at the beginning, the subtitle, I guess you'd say, of the chapter says, scientists are human, often all too human. when desire and data are in collision, evidence sometimes loses out to emotion. Nobel Prize winner quote. Talk just a little bit more about, you've seen a lot of people, you've interviewed a lot of people, you've written a lot of articles. What's your takeaway, and why would you choose that particular quote by Brian Keating about emotion and data, desire colliding? Expand on that a little bit, if you would.
Sure. So the book is about how a scientist, a mathematician named Jim Simons, really conquered the market together with his colleagues. And they are mathematicians, and they believe in science and their scientific approach. In other words, as opposed to, again, using intuition, they develop hypotheses and they test them and they use data. But that all said, they're still humans. And I guess one of the biggest surprises for the book is how much drama was behind the scenes as they developed these systems to conquer the market. I mean, they've got annual return of 66% a year since 1988. You would think that means they go in the morning and they flip on the computers and go get a cup of coffee and the rest is history. But no, that's one thing that kind of jumped out at me, that time and time again, there was this unexpected drama about different approaches, about different individuals, personalities. They couldn't figure things out. How should they react? So that was kind of, in some ways, surprising and actually refreshing, because they're like you and me too. They feel tension, they have panic attacks, everything else, neuroses for sure.
Incredible irony, really, that the whole idea is either way. I sometimes think of trading. You think about the Starship Enterprise. You got Dr. McCoy, who, I mean, he would never actually do anything because he's the pessimist. They're going to go where no man's gone before, and they always seem to work out. So McCoy's job seems to be to, hey, this time maybe the Klingons actually do get us. So he'd be terrible because he'd never trade. Kirk would be awful because he doesn't think he can lose. But it just seems like old Spock would have. He seems like he'd be the guy that does this. These are astounding returns. I'm looking at your article in the Wall Street Journal from November 2nd. And this, I tell people, this flat out, read this. This is a gateway drug to your book because it's fabulous, right? It's amazing. And here you've got some statistics that I think are worth mentioning just to show just how far above this is. Now, these are 66% returns, and this is before investor fees. So, the actual
there's nobody like them.
Yeah, well, but the talent to be able to pull 66% per annum over, 1988 to 2018. The compounding is just astounding. Well, even after fees, 40% 39% is crazy. Oh, you're going to say something.
Well, they actually can't compound. So basically, they cap their fund. This is called a medallion fund, and they cap it at $10 billion each year, which, 66% a year, even if you're returning, basically all the profits they give back to their investors. And over the years, they've kicked out all their outside investors. So it's just the employees of the firm that are lucky enough to have access. And as you suggest, there's nobody ever been close. I mean, he beats Buffett, he beats Soros, he beats Ray Dalio, he beats everybody, which is why I wanted to write this book.
I mean, you got, Buffett is fantastic at about 20. Ray Dalio's at 12. Peter Lynch, and Peter Lynch cheated. No, I don't know Peter. Maybe you do, but you could have, in the period from Magellan, in that 80s tech, when the tech really took off in the 90s, but you could have thrown darts at a stock chart and done 29%. I don't know. That's probably unfair, but
I hear you.
But he had.
I hear you.
But what's amazing? I
hear you. And Simons has done it longer for sure.
Yeah, well, and you look at Simons, and there's another fascinating chart in your article, which I think is phenomenal. It's the 07-08. That's like second and third place. It was in the downward market of 08 that he just crushes it. And 09's not that bad.
I don't think it's a coincidence. So what they do basically is they take advantage of the behavioral errors that we all make, and they do very well in market downturns in terms of the market in general. So to me, that's them profiting from the greed and the fear that we all experience. So yeah, they've got a very different approach to trading. They don't bet on whether a stock is going to go up or down. They bet on relationships. They buy they're long about 5,000 stocks. They're short about 5,000 stocks, and they look for changes in relationships among groups. One group versus another. One group versus an index. One group versus a factor. So it's a whole different way of investing, and they're basically their holding patterns are about 2 days in general. So they're not high frequency traders, but it's very short term.
Yeah, they're swing traders. Now, this is, boy, there's so much to talk about. We can't leave that thought. 5,000 long, 5,000 short. Most people don't even know what a short position is. There are opportunities to short side, but that is a very dispassionate way to approach things, to realize, look, it spends the same. In theory, more risk to the upside for, an infinite ceiling as opposed to a bankrupt stock. But, at the end of the day, if you're trading at 2 days, it's not a big deal. So interesting how dispassionate is. Up, down, we don't really care. This is an interesting, the way you laid this book out is interesting because it's really two parts. There's part one, part two. And I think the titles are interesting. Part one says money isn't everything. And part two says money changes anything. Now, we got 307 pages to figure out what that means. But if you could just give us a preview, kind of moving from your article to the book, money isn't everything. Okay, what do you mean by that?
Well, the story is about a group of scientists and mathematicians who, frankly, didn't care much about the market, yet they're the ones who conquered the market. These are individuals who their own spouses did their family investing. They're not like people who grew up interested in the market and business. I grew up interested in stocks. I used to read books, magazines, newspaper articles, and many people, if not most people on Wall Street, are like me. They actually had a passion for investing. And the irony, the real paradox of my book is that people who couldn't care less about trading are the ones who conquered trading. And that's what I say. Okay, that's the first part of the book. The second part of the book is how they change and they get wealthy, and it changes them. It changes the firm. There becomes tension within the firm, and they use that money to impact society. So one of the founders or the co-CEOs of the firm, Bob Mercer, uses his money to help put Donald Trump in office. And arguably, Donald Trump wouldn't be in office without Robert Mercer. And Jim Simons, the key man of this firm, is a more left-leaning individual, and he's used his money for other kinds of things, autism research, different scientific endeavors. He's subsidizing math teachers all over New York City, New York State. So that's the idea between the two parts of the book. It's how they made their money in unlikely ways. It shouldn't have been these guys. They didn't really care much about investing, and yet they're the ones who did it. And the second part is once they made the money, how they used it to impact society, and it ended up bringing all kinds of tensions to the firm itself.
The contrast between Simons and Buffett is fascinating. You got Buffett, a fundamental analyst, look at the company, buy and hold it, let those dividends he's a really cash flow investor. You look at Kraft Heinz right now, huge SEC issue, drops from 70 to 30, and Buffett says, yeah, we kind of overpaid for it. And you've got, they're writing down their brand equity, and they've got a lot of debt. But Buffett says, hey, look, the price may go up and down, but I'm making $330 million a year in dividend, and I think there'll be ketchup on the table in 10 years, and macaroni and cheese too. So you have this, guy that looks at cash flow investing, and then you have this stark contrast of a guy who's holding stuff 2 days. And so there's this battle between, fundamental guys and quantitative guys, technical guys, which the best. Fascinating that you can find an example, because everyone says, look, I want to trade like Warren Buffett, the Warren Buffett way. I'm going to trade like Warren Buffett. I like, a lot of what Warren Buffett says. You read but here's what's interesting. You read The Intelligent Investor. That's a book on temperament as well, more than how to trade. In contrast, you've got Simon's totally different style, beats Buffett handily Why does everyone know Buffett's name? Is it because of Geico and Fruit of the Loom? Why don't people know? I mean, he's not like Jim is not a household name. Why is that?
It's a good question. There are a bunch of reasons. Jim Simons is very secretive. He didn't want to talk to me for this book. His people were told not to talk to me, as opposed to Buffett, who likes the acclaim and the accolades and the attention. Partly it's because you don't really understand how Jim Simons is doing it. He's looking for patterns beneath the surface. He can't tell you even why they've made money. A lot of it is machine learning and AI, and the machines learn on their own what's working and what's not working. And there's no theme. There's no theme you can go on CNBC and talk about when it comes to Jim Simons. Hey, Jim, why are you making a lot of money this year? Yeah, these 2-day patterns have been successful. We've been able to map them out. There's no theme that the average person can wrap their arms around. So those are among the reasons. But yeah, secretive, and it's hard to understand how they're doing it.
So, this book makes us think about a new world. Data, it's an interesting thing because you have the mathematics, but you also have to have the data to apply the mathematics. I see those as two different, legs of a stool with, however many legs. Maybe it's leadership as the third one. I don't know. But if you look at AI, okay, you have algorithms and mathematics, but those are based on data. And if you look at China, for example, it almost seems as a country, they've said, look, to heck with our privacy, to heck with this. We've got more people than anybody else. Therefore, we can get more data than anybody else. Therefore, we can probably get the best algorithms. So while we thought we were, Googling Google, we found out Google was Googling us, as was Zuckerberg and Facebook. What is the role? I mean, what is the role that data played in his success? Not just being a brilliant mathematician, but what was the role of, how do you collect that much data? Any insight on that?
Yeah, so as you suggest, the key to this whole thing is Jim Simons' appreciation for the importance of gathering data early on. We're talking in the early 1980s when no one cared about this stuff. He was sending employees down to the Federal Reserve, and they would do the painstaking process of writing down pricing information going back decades, and eventually they go back centuries. Literally, they have pricing information about trading going on till the 1700s. Now, sometimes it's helpful, sometimes it's less helpful, but basically they're looking for instances in which similar situations took place and how markets reacted. Let's say there's some wheat prices of wheat go down. There's some harvest issue in Australia or wherever, and how in the past did prices react? And they try to model how they're going to behave in the future. And just the idea of gathering data, first it was pricing data for over a decade, and then they eventually gather, and today they gather every kind of data. You want to know anything, you can go there, they can figure it out. I don't know how many shipping containers are leaving China or in a certain port. They can figure that stuff out, and they test all day long. They test the significance of their data that they've gathered. So they gather data and they test it. And yeah, it's all data science. And today, young people, that's what everyone's trying to do, data science, but they were doing this in the 1980s. So in so many ways, they were sort of ahead of their time.
It's like a slide rule comes to mind before the calculator, trying to do that in the 80s. And what an ironic thing that we're going to go back into the 1700s and, tulipomania maybe, maybe it's even back to Midas of Thialus with the wine press, when the first option guy. And yet you use all this data to be in a trade 2 days, amazing stuff. For sure. Absolutely. So you think you go out, Soros hires technical analysts, Buffett hires fundamental analysts. Jim's not hiring people that care about the market. He's hiring people that don't have a background in this because he doesn't really care about, I guess, the history of them. I guess he's not looking for Wall Street guys. Talk a little bit about how he hired and his thought about hiring his team. What went into that? Because you've got a list of all the players here, that are part of this story, right?
Right. So he's a mathematician, and he doesn't come from Wall Street, so he didn't hire people from Wall Street. And frankly, he doesn't believe in experience and finance backgrounds. In some ways, he doesn't want those kinds of people because they're doing very different things. They're not trying to figure out the why. Why is the market going up? Why is the market going down? And you say to yourself, well, geez, isn't that dangerous? They don't know why they're making their trades. And the way Simon's response is, well, I know that the Earth revolves around the sun. I don't need to know why it does. I can test it and scientifically provable that it is. And he thinks it can get you a little confused. And the general theme here, for me, what I take of it, is the danger of stories and embracing stories. So you look at the biggest, exactly. You look at the biggest mistakes, like investing in WeWork and Theranos and all those kind of dumb mistakes sophisticated investors have made in recent years. And it's because you get caught up in the story. And Simon and his colleagues think there's a real danger there. They don't even want names on their companies. They don't even know. Sometimes they'll give examples for outside investors. Some of the funds have some outside investors. And they'll use an example of a company that's actually defunct, not even operating more, because they don't read the business presses. They don't read the Wall Street Journal. They don't care about the news. They just look for patterns. And as you suggest, as a result, he just hires really, really good scientists, people who ran Stanford's physics department or astronomy or
data
mathematics, different areas of mathematics. Yeah, gatherers, but also analysts, people who can look for patterns, people who can develop hypotheses and do good science. And it's a whole different way of approaching investing, and it's hard to pull off, which is why he's really the only one who does anything nearly as good.
You know, I for years, people had asked me about CNBC. I don't actually watch CNBC for that reason. I enjoy both fundamental technicals. I'm not smart enough to do quantitative trading, but I do care about risk management. You know, I think of a lot of it like a casino. If a person's struggling with this idea, is go to a casino and you'll see a table limit, you'll see odds. That's really the closest thing to this that I could reduce it down to, is if you're on the casino side. You just have certain parameters and rules and data. And I'll see a technical drop or a technical boom. Turn on CNBC, they'll find the story.
Yeah.
It's either really bad predicting the future with two talking heads with opposing opinions that don't know, or you're trying to justify it with a story, from some, maybe a technical move that happened. This is a fascinating book. What was your goal for the book? When a reader, when you said, hey, why would this be valuable for someone to read? Is this just merely a history of an interesting billionaire that's quirky and so different from everyone that it's interesting reading? Or did you write this with an eye of saying, this can help people with their temperament and help them think about the future and how investing might be? Is it to scare us all with big data? What was your goal in writing the book?
So I had a few, goals. One is to write an entertaining book. I think they're interesting personalities and they had impact on society. They continue to have impact on society, these individuals. So I think it's important to understand them a little bit. So one is to tell an entertaining tale, but the other is to give a little bit of an insight to the average reader into how Wall Street has changed. And as you suggest, a lot of people just get their information from CNBC or reading something, and they're looking for explanations for why the market is moving the way it is. And the matter is, it's these computer algorithms that often are moving things, and these people are the pioneers. So I wanted to kind of give people a little more of an insight there. And also there are broader lessons, I think, that can be learned about management, about motivation, because the genius here, Jim Simon's genius is how he managed genius. And he's put together these quirky, stubborn, opinionated, odd often work employees. They all work together. They're all pretty cocky and headstrong, and some are liberals, some are conservatives, some are libertarians. They all work together. So there's some lessons on how. So it's not just investing lessons, but just as a nation, we're more split than ever, and somehow these people make it happen, and they have this success. And given ups and downs, as you know from the book, and the politics sometimes did split them. But I think there's some lessons there as well.
It's such a fascinating time in history. You have, look at some of these big players like Jack Bogle or the late John Bogle, who just passed. if you talk to him, he's like, look, you want to try and beat the S&P, you're wasting your time. I'm going to start Vanguard. I'm going to have these low fees, and you're going to get 8% on average, and that's just what you're going to get minus fees, and that's the way the market is. Okay, this punches that in the face. I mean, this is a brave new world. The other irony is that here we have, I think you cite, and I've heard different figures, but they're all in this realm. Would you say I'd be safe in saying 85% of trading right now is based on this type of quantitative approach, algorithm? Computers are doing the work, right? You got maybe 15% doing it the Buffett way. What do you think?
My numbers suggest 31% of all trading is done by these computer quant types. And that's, in other words, other trading is done by computers, but these are people that are making their decisions based on algorithms. The algorithms make decisions for them. It's 31%, but that's the biggest chunk of the market today. That's more than individual investors and others. So they are the most important reason why things move around.
So look at this irony is if I'm an employee and I go to work and I'm doing whatever I do at work and I'm dumping my money in the 401k and they're saying, look, buy and hold this till you die. So in one breath, Wall Street's saying, look, don't panic, stay the course, doesn't matter, just keep on going. And on the other side, these guys are churning money in milliseconds with high frequency trading, different algorithms, quantitative stuff. I guess the lesson, maybe I have you tell me the lesson, is it that, look, the biggest lesson is things are changing, maybe learn more about money. I mean, what's the big lesson in all that?
Well, I don't think, one thing I'll tell you, the lesson shouldn't be, well, geez, these guys dominate markets with computers. I'm going to get out. Because even people like Jim Simons, with their own personal money, they still invest with some traditional investors. There's still ways to make money with traditional approaches. So I don't want to suggest that you can't, but it's harder than it used to be. And I'm a big believer in index investing and low-cost ETFs and such, because it's gotten much harder to get an information advantage. And I'm not just talking about individual investors, and I write about it in the book. I talk about pros, hedge fund guys, people that do this for a living. They've been underperforming for years. They're doing much worse than the average mom and pop who are kind of got the joke and aren't trying to outsmart the market like they're in the past. You can still beat the market if you're going to focus on a niche, a sector, an area that you've got some expertise, you've got some competitive advantage. But the whole idea in the past was on Wall Street, the big pros used to get tips. They used to have some information advantage. They used to have some ability to beat the market by getting an edge, and you can't get that anymore. So in some ways, it's a much more level playing field. I don't want people to come away thinking, well, the computers dominate and they're outsmarting everybody else and we're in trouble. If anything, the pros that use traditional approaches are the ones in trouble. And the average person maybe has something of an advantage because they can do longer-term investing. That's not what Jim Simons and his colleagues do. They do two-day investing. So if you could be a longer-term investor, 6 months or longer, then maybe you do have an ability to compete.
I'm thankful that you brought that up. I don't like having people on my podcast all the time that just agree with me all the time. It's fun to have some disagreement, but I have to agree on that point. Is I remember, Gregory, I had an old mentor of mine when I grew up. He taught me a lot of life lessons, and he was an old airline pilot, and all of a sudden Y2K is coming 20 years ago, and he's like, is the world going to come to an end? You're a young guy, you know these computers. And I said, his name was Robert. I said, Robert, computers crash already. There's not, I get the blue screen of death now. They crash already. And the fact of the matter is, people can take some solace is you're not competing against high frequency trading and these, you've got, these fiber optic cables. They're trying to get a millisecond. They're drilling holes straight and moving closer to the mark, all that. You're not competing against it because at the end of the day, markets go up, markets go down, companies pay a dividend. And I like what you said. If you can find a system or a niche that you can be consistent with that's unemotional, I think that's the bigger issue, is can you get unemotional? I think a person can do very, very well. You've been so gracious with your time. Let me give out your website again. It's just Gregory Zuckerman, correct? .com?
I think it is, yeah. Yep. But they can also email me. Find me on Twitter. I'm on Twitter, G Zuckerman. I'm at the Wall Street Journal. You can find me easily. I'm on LinkedIn. So all those three ways. And I'll check my website once in a while. But send me an email or LinkedIn or Twitter is probably best.
If someone has beaten Warren Buffett from 1988 to 2018 and given his investors 39% after making 66 per annum, boy, that's a book worth picking up on Amazon.com. It's called The Man Who Solved the Market, How Jim Simon Launched the Quant Revolution. You've been so gracious with your time. Anything you would say to our listeners before we close?
No, I do think there's some life lessons in addition to investing lessons. Hopefully they appreciate it, and I'm open to constructive criticism or compliments and such, so feel free to email me.
Well, I only have compliment on my end, and it's one of the advantages of having a podcast is you get to talk to the most interesting people in the world. I hope we'd be open to having you again sometime. I'm sure you're not finished with books, and also I do read the Wall Street Journal. I don't watch CNBC, but I do subscribe to the Wall Street Journal. It's the only paper actually I subscribe to. It's the only one. And so we'll be watching for you there. And if we see a great article, I'd love to chat again if you're willing.
Sounds great. Have a great holiday.
Fantastic. Thank you so much. You've been listening to the Cashflow Academy podcast. Our guest has been Gregory Zuckerman, and we'll see you next time.
You've been listening to the Cashflow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.